How bull market is this bull market?
It is certainly a bull market, not just within prices, but certainly within the earnings. And that's why this market has been so powerful and resilient to everything you've thrown at it this year, is because unlike prior times when you've had things like energy shocks and geopolitical crises and you would see earnings estimates get cut, you've seen earnings estimates go up 20% on a 12-month forward basis this year, which is why this market has been able to shake off any kind of negative news.
On a personal finance basis, are we enjoying it, or are we totally out of whack where our allocation should be?
Well, if you look at the aggregate allocation metrics out of something like American Association of Individual Investors, what you can see is equity allocations are at all-time highs at 71% allocation. So this gets you back to prior highs that we saw in times like 2021 or 2018. So certainly this looks like an individual or a household area that is all in on equities. You see a very different story when you look at institutions, where institutions are the ones who've been sitting on the sidelines. Something like Deutsche Bank's consolidated equity positioning is just in the 41st percentile. So it's a tale of very different cities. Households are all in, institutions are on the sidelines.
Interesting dichotomy there. You look at the S&P 500, we've had 3 straight years of double-digit gains. The S&P is up about 10.5% now. When we're in this long-running bull market like we have right now, do individual investors tend to turn more conservative, stay with what's worked, buy and hold, or are they more willing to go out on a limb and consider, moving some assets into uncorrelated securities or products, maybe venture into private assets?
Well, I think there's 2 different questions there, because the first one is, do people start chasing the hot dot when it comes to market leadership? And one of the reasons why the quality anomaly exists, why if you look over the long run, the quality factor has actually added a lot to portfolios from a return basis and not added to risk, is because people do tend to chase the hot dots in markets like this. They want the non-profitable tech company. They want the shiny new object. But what you find is that just as fast as those kind of assets go up, you have the same kind of problem where they can have very deep corrections on the other side. When we think about allocating to private markets, that's where you're looking and saying, look, we've had 15 years of effectively double the average returns for public markets. So we need to diversify the return streams, diversify the income streams, and you need to look to private markets in order to find those different sources of ways to get to overall portfolio diversification.
Let's go. Can we go mathy on a Friday?
Go mathy.
Let's go mathy. Here it is right now. This is one of the most famous money must-reads out of the Wall Street Journal years and years ago, 2003.
Back in the archives.
Mark Horman, as an extreme example, consider the equity allocation of 1793. Today, you would be 99% equities, an all-stock portfolio over time, much riskier than a classic 60-40. Cam Dawson, explain the best approach on the x-axis to proper retirement allocation.
Well, I think that there has to be a very holistic approach to the entirety of somebody's portfolio in life. Not formulaic. And I think that this is the big issue within wealth management, is that most people try to make everything institutional and homogenous. They try to treat everybody the same. But just as we talked about with things like financial planning and wealth strategy and something like prenups, those considerations have to be reflected in the portfolio. Those liquidity needs have to be reflected in the portfolio. So having the right allocation is not just going on the efficient frontier, it's actually doing the holistic work to understand somebody's complete balance sheet in order to get the mix of assets that allows them to withstand volatility.
I want to go back to that point, Cam, where you talked about tailored portfolios, tailored allocations, and tailored approaches to managing your portfolio. Does that mean things like model portfolios, which are kind of cookie cutter, don't make sense for wealth investors?
I think that as somebody's wealth grows and as they get even more complicated, typically we do see complications or it certainly expand as the amount of assets do grow, that we find that we have to tailor different portions of the portfolio to have the right kind of allocation. Because if you have high liquidity needs, having something that's invested in completely private markets makes absolutely no sense. So instead of treating an allocation like going to a big golden corral and picking everything off the menu, you really have to choose the things that are having the right functions for what you need.
How much of our certitude about this, what Nikki Waller deals with every single day, the myths that we have, the foundations, was built on the great moderation, where it was just price up, yield down forever, and then in 2022 we hit a wall.
Well, and I think that all of these asset allocations, these mean variance optimizations, are all built on one very problematic assumption, which is that you'll have standard normal outcomes, that you will have predictable outcomes.
Did you see? Did you tear up over that standard normal outcomes? We're going to go Gaussian in a moment. Finish up and save the interview.
So I guess what it comes down to is any portfolio, especially one tailored for an individual, needs to account for emergency liquidity.
Yes.
Where does that come from?
Well, I think that it's building out a certain degree of a cash side of portfolios to meet the liquidity needs over a shorter period of time, having an income generation part of the portfolio that has income sources from different sources.
Right.
So this is not just fixed income, bonds generating income. It's looking at something like potentially private credit, if you can absorb the illiquidity there. In certain areas, do it carefully, GP stakes. And so you have to think about diversification, not just within the overall asset class, but what you're trying to achieve by each asset class.